It is a bit of a cliche to say that markets are primarily driven by fear and greed. But like many other cliches, this one contains a strong element of truth. The fact that emotions drive markets is particularly true during bear markets, like the one we are experiencing right now, and the looming recession the media is reporting about. And every bear market presents its unique challenges, especially to investors' psychology, as the desire to feel safe is a basic psychological need and, in a way, a primal instinct that kicks in when we suspect danger. But of course, a bear market does not only present challenges, but also opportunities and potential long-term rewards. So in this video, I'll share 5 tips that should help you navigate difficult stock market environments and that may help you to survive the current as well as future bear markets without hurting your portfolio's long-term performance. Alright, hey there, my name is René Zellman, and to start this video, let's briefly define what a bear market actually is. So a bear market is a prolonged period of stock price declines, typically a decline of an index, such as the S&P 500, of 20% or more from a recent high. And with that being said, let's take a look at the first tip that I want to share with you to survive bear markets as an active stock picker. So my first tip is to quite simply turn off the noise. And by turning off the noise, I mean that you should significantly reduce your consumption of financial media. Don't watch any CNBC or Bloomberg TV, reduce your use of Twitter, read no financial news. It's important to understand that emotions drive clicks, which translates to ad dollars for financial media companies. Just go to any financial media website, search for the term recession, and you will find an almost endless stream of articles warning about the consequence of a potential recession. The following paragraph from the paper The Media and Markets: How Systematic Misreporting Inflates Bubbles, Deepens Downturns and Distorts Economic Reality summarizes the underlying issue quite nicely. Just as the parade of crime and disasters on the nightly news is only a highly distorted version of the actual world, so the economic and business news is but a skewed and selective snippet of the real economy. When it comes to political or general news, we've long been familiar with the way in which media skew reality through soundbiteism, a focus on personalities and conflict, and the preference of bad news over good. Media compete for attention. Editors tend to pick the simplest and most familiar narratives and templates, and reporters often don't question their sources or dig deep into a story. Why should we believe that business and economic journalism is free of those afflictions? This paper was first published in 2014, and arguably over the last 8 years, the world has become even more interconnected. And financial news spread even faster on social media platforms, and it's easy to always know what is happening in the stock markets around the world right now. So instead of increasing your exposure to financial media during volatile time periods, limit your exposure and instead live your life. Meet friends, pursue your hobbies, and understand that your portfolio does not define who you are and how successful you are. Let's move on to my tip number 2. My second tip is to focus on companies' cash flows. I think especially during the bull market leading up to the COVID crash, the loose monetary policy and the ultra-low interest rate environment have led to the emergence of a ton of businesses that are structurally unprofitable and or have blown up cost structures. Too many employees, too little urgency, and too little focus. All of this may be obscured when the market environment is favorable, but when the economy turns, these underlying issues will become very apparent. So let me remind you of an investment principle that Warren Buffett has popularized, and that may be more important than ever right now. Simply stick to simple, predictable, and free cash flow generative businesses that have a very dominant position in their industry. Conversely, Buffett has also said that the worst businesses that you can own are those that grow rapidly but require significant capital to fuel that growth. And then these businesses generate little to no profit. So again, focus on profitable businesses that generate large cash flows. Because if a difficult market environment turns out to be more persistent than desirable, then the underlying profitability of that business, the cash generation, gives the company and the stock in your portfolio an additional margin of safety and guarantees that the business will survive the downturn, will survive the bear market, and may even come out ahead, as it can invest aggressively when its competitors are unable to. And thus the business may even take market share away from these competitors. Alright, tip number 3. Not only do you want to avoid unprofitable businesses, but also businesses that carry a lot of debt, arguably too much debt. Especially the current bear market is primarily driven by a change in the default monetary policy by central banks all around the world. And obviously, increasing interest rates do not only have an impact on asset values, but also on businesses' underlying operations. Companies' long-term debt, if interest rates on their loans are variable, simply become more expensive, which in turn will eat into companies' profits. Now, personally, I generally want to own businesses that have a very healthy balance sheet, that carry very small amounts of debt. And I want to own even more of these businesses during recessions and bear markets, because this allows me to sleep well at night and make, unemotional decisions and to remain, rational when arguably everyone else around me is not. Now, you might be wondering, how much debt is too much debt? Well, it's always hard to come up with general recommendations because businesses are so different and so unique. But ideally, personally, I want to own businesses that are able to pay down all of their debt within 3 years if they would allocate all of their cash flow to the reduction of their debt. So in other words, I want to own stocks with a total liabilities to free cash flow ratio below 3 or 4. Alright, here's tip number 4. I think during bear market it becomes apparent that human beings are not the rational creatures that they would like to be. No, often bear markets lead to herd behavior, where investors simply follow what they perceive other investors are doing, rather than focusing on their very own analysis. And that's because herd behavior, as many past stock market bubbles and stock market crashes have shown or illustrated, well, this is usually not a very profitable investment strategy. Sure, bear markets are uncomfortable, and I know you will feel that urge to in some way ease the pain. But please realize that you should not let your emotions overwhelm you and should not impact your investment decisions. Making hasty decisions based on the behavior of other market participants is most certainly a losing strategy. Instead, understand that the development of a stock's share price may have absolutely nothing to do with the development of the underlying business. So I think to be able to zoom in on the development of the business you own and ignore the short-term and medium share price performance, you should only invest in businesses that you understand and know why the future of that business looks bright. I think it's always helpful to write down your investment thesis when you make a new investment, because when the market turns and when everyone seemingly wants to sell that stock and dislikes the business, you can just look at your thesis again and try to rationally assess whether your original investment thesis has changed. Okay, finally, tip number 5 is simply to keep a long-term mindset. I think during bear markets, it's important to remind yourself that the US stock market, as measured by the S&P 500 index, has generated an annualized average return of around 10% between 1957 and 2022. So if you believe that this long-term trend will not all of a sudden stop, you should regard bear markets as opportunities offered by an irrational Mr. Market. He is offering you to buy more shares at a discount. And if you buy these stocks at depressed valuations, your forward returns may even surpass average historical returns. Consider the bottom of the 2008 financial crisis, for example. Obviously, investors' sentiment was incredibly pessimistic, yet forward annual returns were absolutely incredible. Alright, I hope these tips help you change how you behave during bear markets and help you see bear markets and market volatility through a different lens. And if you want to learn more about how you can find high quality businesses, highly profitable businesses, I recommend you check out the following video next. Take care.